Good afternoon, everyone. Today I'm chatting with Adrian Day. In today's interview, we get into gold, what's been driving the price, and how governments have completely lost sight of the value of the dollars that they allocate. We also get into mining investing and how you have to be careful if you are playing on the riskier side of the risk curve, and what to think about if you're trying to make mining investments for the first time. All right, everybody, enjoy the interview. Adrian, thanks for hopping on today.
Oh, you're welcome. Thanks for asking me. Interesting times, eh?
I imagine, and that's what one of the first things that I thought when I realized that I was having you on today is just you've seen some cycles, and for myself, I've never really seen a junior mining market. I originally started investing in mining companies around 2010 when I first heard Ben Bernanke say the words quantitative easing and realized that it's not a complicated bet. The system just doesn't work when governments are allowed to just do whatever they want and there's no fiscal guardrails. And I, at the time, I first went pretty heavy into gold and around probably $1,900 and watched it come all the way back down. And I remember chatting with a friend a couple of years ago when gold wasn't doing well back in 2022, and sort of thinking like, well, is the gold trade dead? Because gold should be doing a lot better right now than it is. And here we are with gold over $4,100 at the time of filming. And it appears that the gold trade is not dead at all. And those of us who had that thesis were right. So let me start by asking you, what's going through your head right now when you look at the price of gold and you just think about the overall market and where we could be heading?
Yeah, no, good question. First of all, I remain very bullish on gold, over a 1, 2 year period. And the reason is really quite simple, and that is that all of the reasons that all of the people have been buying gold in the last 3 years, they still are intact. And whether it's central banks wanting to diversify out of a currency of a fiscally irresponsible government in the midst of dollar weaponization, or whether it's wealthy people wanting to protect themselves from too much debt in the world, none of that has changed, right? If anything, it's all going in the wrong, it's continuing to go in the wrong direction. And so I think the buying is just going to continue. Now, there is a question, of course, and this is more important even for the gold stocks, which I'm sure you'll come to in a minute. But, obviously we could have a pullback at some point. I'm not expecting a major pullback, to be honest. Gold has been remarkably resilient over the last 3 years. I mean, just remarkably resilient. And any time when you thought, oh boy, this could be the correction, it's, a few dollars down for a couple of days. And we had that long period from middle of April to the beginning of August when gold was kind of flat, but it still didn't go down. But of course, there's always a concern that we might have a pullback, and even a 10% correction in gold, even if it's only a couple of months, it would sure hurt the gold stock. So, we're not 100% in at the moment. It's nice to have some firepower in reserve, not only for a market pullback, but frankly, just for individual stocks that might pull back, or new issues that come to market, or whatever it is. It's always nice if a stock pulls back on an overnight deal or something, such as happened to Ola a month ago. It's nice to have the money available, so you just buy it.
Mhm.
Anyway, yeah, but no, I remain very, very bullish.
Now, you've seen cycles before, and right now, for anybody in our audience who's been playing on some of the stocks that we've been chatting with over the last few years, you can almost throw a dart at any of them, and they're up, 300% over the last 12 months. Uh, when you look at this market where the best way to probably put it is stocks are just re-rating. I chatted with one portfolio manager today and he said ideas used to be worth $2 million and in this market they're now worth 10, and individual drill holes that are of strong significance are now suddenly worth $50 million. And that wasn't the case, just a year ago. Now, you've seen these cycles before. Is this one any different? And how should we be interpreting it as investors?
Well, you know what John Templeton said, the four most dangerous words in the investment lexicon. This time it's different. Um, let's just say that there are some differences. Is I can get away with saying that. Um, and I think in the past, we've always had these big corrections mid-cycle. So in the 1970s, from 74 to 75, you had gold actually drop 100%, from almost 200 to just $100. I can tell you that a lot of people said it's over at that point. 2006, we had like a 30% correction in the space of a couple of months. And people tend to forget that because we know what happened afterwards, right? But still, mid cycle corrections are not at all are not at all rare. But I think where we are right now, we can say is different from previous gold cycles in the sense that ordinary investors, ordinary everyday investors, not gold specialists, not gold bugs like me, not sophisticated investors like Ray Dalio or anyone, but ordinary everyday investors and generalist investors, generalist funds, they are not in this market. They're not in this market. And I have never known a market top without public participation. Almost by definition, you don't get a top until the public is in it. And of course, we all know why that is. We all know why gold has gone up 100% in the last 2 years or whatever it is, 60% this year without the public participating. It's because other people are buying gold who were not buying it in 2009 and were not buying it in 2000, 2 and 3. But the public's not in it yet. So I have no doubt that we will get a significant correction at some point. I'd sort of be surprised if it was now.
Mhm. It seems like that. Like, it seems like, and I don't have the numbers in front of me, but it seems like we have hit all-time highs in the price of gold in something like, I don't know, 30 of the last 40 days. And it feels like when we do get these pullbacks, they're tiny and they're short-lived. And sometimes I wake up in the morning and I'm like, oh, gold's down $80 today. I guess maybe we hit that top, and by 2 p.m. that day, we're hitting all-time highs.
Well, today's a perfect example, isn't it? It was up meaningfully. Gosh, let me just look at the numbers. It was up meaningfully in Asia overnight. Got up to what, 4170 or something. Yeah, got up to 4177, 78. And then suddenly collapsed when Europe opened. Good old Europeans, we can always rely on them. But it's come right back, 40, as you say, 4150 right now. So it's just remarkably resilient. And what it shows me is that there are people waiting to buy in different markets, in Asia, in Europe, in the US. There's different types of investors just waiting to buy.
One thing that scares the crap out of me, and maybe this is just because of the world that I work in, and I'm talking with mining guys all the time and investors in precious metals, and it's just sort of my long-term thesis playing out right in front of me, is that what we're seeing in the price of gold could be very scary for, I'm based here in Canada. I'm not sure where you're joining us from
I'm in
today.
Puerto Rico.
In Puerto Rico. So for myself here in Canada, when I look at the price of gold, and like we always hear, okay, well, the Bank of Canada, I think if they have a rate decision this week, well, they might go 25 basis points. If they don't, there's an 80% chance that they'll have a 25 basis point cut by the end of the year. But then it's like, if gold is telling us something, it's that inflation may be back in a big way. And I don't know that people really understand the problems that we have ahead of us if gold is telling us that. Is that a fair assessment?
Yeah, yeah, it is. But I don't, they say be careful what you wish for, and I think nothing could be truer in the gold market, because of course gold is an asset that tends not to do well when everything else is doing well. Tends not to. If the economy is really strong and inflation is low, and unemployment is low and peace is around the world, um, gold tends not to do well. The fact that it is doing now, and frankly, the fact that it hardly budged with the Gaza peace deal, which, as a tangent, I honestly don't think that the war in Gaza added much to the gold price. So it's quite logical it doesn't remove much when there's potential, well, when there is for the time being a peace. But nonetheless, gold is definitely telling us something. I think it's warning of inflation, but above that, it's warning of unsustainable deficits in the U.S. and around the world. And there's a big picture thing here that the U.S. having the world's reserve currency since basically 1945, first under Bretton Woods and then under, which was a pseudo gold standard, and then particularly after 1971, when the final link to the gold standard was broken. The dollar has been the supreme reserve currency in the world, which meant that they, which meant the US could print more dollars than they needed for their own economy, knowing that other people, individuals, institutions, central banks around the world would soak up those dollars and prevent inflation getting out of control in US. Essentially, the US exported its inflation. Obviously, what we've been seeing recently is the move away from um, uh, U.S. total sole dominance, and the U.S. dollar being the sole reserve currency. And that's been going on before this administration came in, but of course it's stepped up since this administration came in. And you've had, Saudi Arabia and China making an agreement to do trading in the yuan, not in the dollar. And so the dollar is losing some of its dominance in global trade. More noticeably and more significantly, it's losing its dominance in central bank reserves. And to the extent that the US loses its sole dominance as the world's reserve currency, that means that there is less buying for US assets, and there will be some selling of US assets. And all of the dollars that have been created since 1971, and in the US, it's been a total binge, right from Alan Greenspan, who should have known better. Well, he did know better, but um, it's been just money printing after money printing. And now you don't even need a crisis to print more money. All of those dollars still exist. They haven't gone away. And the sort of anecdote, the hypothetical anecdote I like to say is, you've got a Colombian drug dealer, right? Sells his product in the US, collects US dollars. Was he in a hurry to exchange those dollars for Colombian pesos? I don't think so. If I go to Romania and get a taxi and say, "Oh, I'm from the airport. I'm sorry, I've only got dollar bills." Everybody around the world, including the Romanian taxi driver, would accept dollar bills. Do you think he was in a hurry to exchange those into, is it leu in Romania? I forget now. Anyway, but I mean, the point is there's dollars stashed away, not just in central bank reserves, but in, Romanian taxi drivers, hotels in Thailand, drug dealers in Colombia, etc., etc., etc. And to the extent that the dollar loses its supreme role, its role as the supreme and sole reserve currency, then to that extent, people start to lose confidence in the dollar and they start to exchange their stacks of dollars for other currencies. And those dollars all come back to the US. So we saw this in 1945 in Britain. And so what's going to happen over time, it may not be this year, it may not be next year, but what's going to happen is those dollars are going to come back into the US, and that, of course, will feed inflation.
It's, getting back to what I said before about when I first heard the words quantitative easing, and I just sort of think about what just the lack of fiscal restraint. Justin Trudeau here in Canada was running like $60 billion deficits. Now we're starting to hear estimates that Carney's in his first year is going to do $100 billion. And then we think about, in the year before COVID, the US ran a deficit of like 700 billion. Now those deficits are coming in at 2 trillion. And then you think every time the government goes out and they hire a public worker, it's not just cash they're getting. They're usually getting these huge pensions associated with it, which I think that the number we often hear, and I don't know how perfect it is, but it's somewhere north of $100 trillion of off balance sheet liabilities that the
Correct.
US has. And it just seems like there's a breaking point in the system where at some point fiscal prudence just got thrown out the window. Governments were like, we can just do whatever we want. Money's not real. And it doesn't matter. And it feels to me like in real time, the world's about to find out that all of those deficits and all that money printing actually does matter.
I couldn't agree with you more. I couldn't agree more. And the problem is that these problems build up over time. Small little problems, a small exception here, an excuse here, and they just build up. I mean, a classic example to me is the US Social Security system, which when it came in 1946 was meant to be an insurance program, a self-sustaining, self-funding insurance program where workers put money in. At retirement age, they collected a payment, and the idea was that we shouldn't have older people starving in a rich country. Okay. Now, when Social Security came in, the average life expectancy of men, and men were the primary workers then, the average life expectancy of men was less than 2 years after you were allowed to take your Social Security payment, right? It's now 20 years. And the problem is for, what is that? That's 70 years. This problem has been looming. People can see it. Anyone with half a brain can see this. But they, meaning Washington, they just refuse to face these things and deal with them. I think for two reasons. One is, they're only concerned about getting reelected. So their definition of long term is until the next election. And the problem is it is always difficult to give people something and then to take it away. And so the government keeps giving, but never pulls back. And we saw this with, earlier in the year with the so-called big, beautiful bill of President Trump. It's, well, I'll support the building in your district if you support this green energy initiative that I like. Well, I don't like your green energy initiative, but I want a building in my district. So yeah, I'll do that and you do that. So Nobody says, well, I'll tell you what, don't support the building in my district, and I won't support the, flyover in your district. Nobody says that. They both say support. So the House comes out with a I can't remember the numbers now, but let's hypothetically a 5% increase in the budget. And they go to the Senate. Same thing happens there. They come out with a 5% increase in the budget, but they have different things that they want to raise money for. So then it goes to the House Senate Reconciliation Committee. Do you think they compromise and say, well, look, let's cut this and let's cut that and keep this and keep that? No, they just agree to include everything that anybody wants. So when they go to reconciliation, it goes from 5% increase to 8 or 9% increase. And that's just the way it's done. And there's a handful of people who speak against it. A handful, like Rand Paul and Tom Massey. Very few people speak against this. And of course, it's the same in Canada. I thought Carney, who I don't like, by the way, I thought he was supposed to be the responsible guy. Well, we get rid of Trudeau, who didn't know a thing. He was an art teacher or whatever he was, a drama teacher. Now we've got a real statesman who understands finance and how the world works. And you're absolutely right. There's been no change.
I don't even want to get into Carney because I'll end up going on a 4-minute rant about that. And those of us who work in capital markets, I'll just say this: those of us who work in capital markets, we understand what Carney is about, what he came from, and people are going to find out. As Rick Rule said to me, Mark Carney is just a competent Justin Trudeau, which should scare the crap out of you.
I know, you'd rather an incompetent one.
So I think we both agree that that gold's probably in a strong place, likely going up from here. We don't know the exact path. And that it is a scary time for regular people who don't know how to protect themselves. And we have a lot of people in our audience who they invest in mining companies, and they're trying to build their watch lists. They're trying to do their due diligence and figure out how do they protect themselves for uh, a market that actually might turn in favor of mining. We've got a taste of it now, but it's still early days. It's nothing like what I hear about the old bull markets used to be like. It looks like we're starting to move back to that. Now, for those people in our audience that are trying to do their homework, they're trying to figure out how to position themselves. I'm not asking you to give any recommendations or anything, but what are the things that they should be thinking about when they're trying to figure out how to get positioned into mining companies?
Yeah, well, I would say, I mean, we all know that bull markets tend to start with the larger cap miners and royalty companies first, and then they move down, to the smaller miners and developers and so on, before they finally get to the exploration stocks. Now, if we're right that the public and the generalists are not yet invested in this market, those people are going to turn to the big cap stocks first, right? So, the hypothetical dentist in Oklahoma who calls his financial advisor at Schwab, both of whom are equally ignorant of the gold market, and say, hey, I think we should just have a little bit of gold. Well, they're not going to buy Ajax Exploration or something. They're going to buy Newmont or Barrick or the GDX, right? And so I don't think it is too late to be buying the big cap stocks. And you look at Agnico, for example, it's not, these stocks are not going to be the best performers in the next leg. No question. But I think they will participate. They will give you very good returns, and they will give you those returns at lower risk than some of the smaller companies. So that's the first thing I'd say. The second thing I'd say is whether you're buying the big cap stocks or the small cap stocks, at this point in the cycle, I would really stick with quality. The stocks are still undervalued. That's the important thing to realize. Despite the price increases, they're still undervalued. And so you really don't need to go to, poorer quality and so on. And if some people say, well, I'm buying XYZ because it hasn't moved yet. Well, ask yourself a question. Is there a good reason why it hasn't moved yet? I'm not a momentum investor by any means, but sometimes there's good reasons why certain stocks don't participate. And there's reasons why other stocks are leaders. And it's always a good idea to stick with the quality, in my view.
That's exactly. You mentioned Agnico, and I was chatting with my mom about it, and she's more we'll say risk averse, and I'm not gonna tell her about some of the things that are further along the risk curve. But when people do ask me about how do they get positioned, I usually say, look, with Agnico Eagle, at least you're getting a name where the management team is incredibly sophisticated. They don't do dumb things. They're most almost everybody I talk to says that they're the best operator in the space. That's usually the name that I usually circle as the well. At least we know that it's a really well ran company with strong
Sure.
capital allocators.
And you know that as a registered investment advisor, I'm not allowed to guarantee anything. But if I were allowed to guarantee anything, I would guarantee that if gold goes to $5,000, you know that Agnico is going to be up. Ajax exploration may double or triple, but it may not be up. And I can also, if I were allowed to guarantee, I could guarantee that if the gold stocks drop, Agnico will drop, but it'll probably drop less than a lot of the other ones.
Exactly. I had a conversation with a guy last week who was trying to raise money for an exploration company out of Vancouver. I'm not going to say which one, but he started telling me about these groups he's hiring in Germany and these groups he's hiring in the USA, and he's trying to raise money on a 4 month hold deal. And you can really quickly figure out what's happening. He's got a bunch of cheap shares. He's using people to raise money into a 4 month hold deal that are locked up, where he can go out there and start selling all of his various founders shares or shares he didn't pay anything into a bunch of wash trading that isn't real marketing. There's no actual real business being built. And I mean, not to say that that is every exploration company. And it's one thing that we kind of want to really kind of steer our audience towards is trying to avoid those names and those characters. But you just don't know. To your point, these companies, they they could do something massively dilutive and massively stupid. I mean, we were in one name that we even had on our channel. They had a really good gold asset, and the CEO basically just gave away the asset for nothing to one of these types of Vancouver promoter groups. And I mean, we've had conversations about suing the guy, but eh, I usually just lick my wounds when these things happen and move on. But I mean, that's the kind of risk you're taking on if you invest in these early stage companies and you don't know what you're playing with, which is why if you're not going to actively be involved and be chatting with the people and understand what you're playing with, why I think you're best off looking at those names.
Yeah, and I would also say that make sure you're dealing with quality people. And if you're a regular investor for whom this is not a full-time job, and ask people, ask me, ask you, if Rick Rule says the guy's competent and honest, you know, that's worth listening to. But if you can't find anyone in the business who knows the guy or has a good word to speak, that's a big warning sign. So, I mean, I'm not expecting every ordinary, everyday investor putting $10,000 into a handful of stocks to know all the players in the business intimately. But, it's easy to ask. It's easy to ask. There's a lot of people. My friend Lobo has this thing called My Take, a subscription service. And he has a thumbs up or thumbs down on pretty much every junior stock out there. I mean, there's good people. You just ask people.
Yep. Well, Adrian, you've been generous with your time today. I really appreciate you sitting down here and chatting with us. I know you're always a hit on our channel whenever you take the time to do it. I also congratulate you on the recent success you've been having. I don't even know what your portfolios look like, but I assume that someone like yourself is having a whole bunch of success. And the thing I like to say to people that work in the industry that have kind of gone through the bad times is that we've earned it with all of the faith and pain that we've gone through some of these rough years. And I always appreciate you sitting down here and giving us your insights.
Well, thank you so much. I really appreciate it. And we'll do it again.
All right, everybody. Thank you for watching. If you enjoyed this interview, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody. Thanks for watching.